Part B of our market update tonight are 6 observations. So we're moving away from the down and dirty data into this notion of 6 observations that I've made about real estate. Now, these observations are very helpful to try and assist you to do what do you think? Starts with where's. Okay, so if I come back for a second, I've just thought of something. Do you believe that if you had the right strategy, you could make money out of real estate in the market at the moment? Yeah, okay, so it's not a question of whether or not investing in real estate can be profitable. We can put a tick here because we've just looked at positive cash flow properties, even regardless of capital growth. And we also identified that there are areas that are growing strongly at the moment, and we need to do further investigation about what is it that makes those areas grow so strongly, and it's probably something to do with jobs, people moving into the area causing prices to go up, or new houses being built, and that's causing the value of older houses to be lifted up. The second thing is a question of, right, well, if we know that we can make money, the next issue we have to overcome in our minds is it the right? And that's a big challenge for us at the moment, because with all the negative publicity that's going on, we're afraid to invest in case it all does crumble down around us, and we need the money and the money's tied up. But now, I would argue, is actually a good time to be investing. Why? Because in a market when there are more sellers than buyers and properties are going down, you can negotiate better. You have inherent leverage, which is important in order to try and negotiate well, because the fact that you are a buyer in a down market is leverage. So I think the timing, even though it may not be ideal in regards to certainty, is more advantageous now than when the market's going up. Because, of course, when the market's going up, we all want to try and get a great property, don't we? But they don't necessarily exist as much as they do now. And then the last issue, timing feeds into your confidence. So if you knew you had the right strategy and you were confident that the timing was okay, the only thing you need to move ahead is confidence. So if you can find the confidence to move ahead, then all the ducks are lining up and you can go away and take action. Fantastic. See how these 3 things align to help you to achieve your goals. And if you're not achieving your goals, you've either lost track of your strategy, you've lost track of the timing, or you've lost track of the confidence you need to keep moving ahead. And the way to get back into the investing game is to find the strategy, find the timing, and find the confidence. So these 6 observations, it's no fluke that the very first one is that confidence leads market momentum. From my experience buying hundreds of properties all around the world, there's no doubt about it that confidence is the wind that powers the property market sales. When people are confident and they're out buying real estate prices naturally rise. When people aren't confident, they're not out buying real estate, property prices naturally fall. Now, confidence is affected by 2 factors. It's affected by greed, and yes, that's Mr. Greedy up there on the slide. How optimistic are people about their prospects for financial gain? If people are really optimistic, if they're really confident, they'll act because they think there's very little downside. And on the opposite side over here, we've got fear. How afraid are people of losing the buying power of their money? And there's this constant tussle that's going on. Lucky for us, there are organisations out there that actually measure confidence. And for your viewing pleasure, here's a graph courtesy of RP Data with the headline, this is a couple of months old now, "Consumer confidence approaches GFC lows as the negative data flow starts to bite." Sounds like a good movie title, doesn't it? Now, 100's par, and the confidence level fell to 92.8, its lowest reading since May 2009. Why? Well, apparently the weak sentiment is reflective of subdued economic conditions outside the resources sector and the ongoing uncertainty surrounding key overseas economies. People don't know what to do. There's another point in a second. They don't do anything. Confidence starts to sap, and they just think, oh. So what's happened since then? Well, newsflash. November 10, 2011, the Westpac Melbourne Institute Consumer Confidence Survey made after the Reserve Bank of Australia cut interest rates on Melbourne Cup Day recorded a bounce of 6%, enough to push the index into positive territory. What is it that's going to drive property prices higher? The answer is confidence. And as confidence was negative, then property prices will drift. But if confidence rebounds, property prices will eventually stabilise and drift up. Now, by the time you hear about property prices going up, it would have already happened. So one of the pre-indicators to property prices moving is confidence. Looking at a graph of the movement in consumer confidence, that's what they mean by a bounce. It went from a negative movement to a positive movement, now over 100. So people are a little bit now positive more so than negative. Looking at what happened, it really dipped down. And as far as business confidence goes, par is 0. It's now at +2. So this graph hasn't been adjusted yet. It was slightly negative, and it's now started to be a bit better. Now, businesses being confident means they'll employ more people. They'll start investing in plant and equipment. So that then feeds into consumer confidence. It's not time to do cartwheels and handstands down the street or anything else like that. But it looks like we're stabilising. But we need to look over the months ahead, and particularly into Christmas. Look how retail sales are into Christmas, because as people are more confident, retail sales are going to improve. If you've been to market updates before, you will have seen me do this. This is just a really simple matrix that I put together. I think I included it in one of my books, where I have the economic conditions prevailing and the emotional conditions prevailing, and we add those two things together, rating them against weak, neutral or strong, to get some idea, some snapshot as to what's going to happen into the property market. And so you make your own decisions about the economic conditions right now and write it down. It's either strong, neutral or weak. Go, make a decision. Get a pen, write it down. Is it strong, is it neutral, or is it weak? And then do the same thing for how you think the emotional confidence out there is in the marketplace at the moment. Is it strong, is it neutral, is it weak? And then find the fit for those two things as to what's going to happen to property prices. I'll give you 5 seconds to find what you think is going to happen to property prices depending on what you think the economic and the emotional conditions are right now. All right. Let me see if I can read your mind. Who thinks it's neutral economically at the moment? Aha. Who thinks it's weak? Who thinks it's strong? All right. Looks like the neutrals have it. And who thinks emotionally the conditions are neutral? Hands up. Who thinks it's strong? Who thinks it's weak? 50-50. So we are either neutral, which is neutral to moderate growth, or neutral, weak, which is poor to neutral growth. I would have said in the market at the moment, we're neutral as far as our economic conditions go, and we're actually neutral and improving rather than neutral and weakening, which means we'll go from neutral to moderate growth into moderate to good growth. Unless there's a major confidence sapping event, such as a financial crisis in Europe or a war or something else that could happen in the meantime. Now, when I did my market update earlier on this year, I said that we were neutral and probably weak into the emotional, and so it was going to be poor to neutral growth. So I'm not just telling you something for the sake of telling you something. Like if I thought it was bad news, I'd tell you it was going to be bad news. And we're certainly a long way from weak and weak, which is poor growth. So where are you at right now? You're either an optimist or you're a pessimist or you don't have an opinion. Right? If you could try and form an opinion right now, and your choices are either you're an optimist, you think things are going to be okay, or you're a pessimist, you think the world's going to end, have 5 seconds to think about it. 5, 4, 3, 2, 1. Hands up people who aren't going to put their hand up. All right, thank you. Can we see the pessimists? All right, very good. Pessimists, if that's the case, back yourself in. Don't invest. Sit on the sidelines, watch what's going to happen. If you're right, you'll make money because everyone else's investments will go down and you'll preserve the value of your cash. If you're wrong, you'll lose money because property values will go up and your cash will buy less property. Hands up, optimists. It's buying season! Because you're optimistic about the future. There's no reason why you shouldn't be buying right now unless you don't have the time, the money, or the skill. Why do you have that belief? Try and understand that, and as you think about why you have that belief, ask yourself, who is giving me the information I need to make good investing decisions? What opinions am I listening to? And those opinions that I'm listening to, are they helpful? Are they informed? Should you be listening to them? Is the person giving you that opinion actually doing it themselves? Or do they like to espouse good knowledge? I'm going to write something down here. I haven't written at any of the other market updates I've done so far. It's just popped into my head. And normally when things pop into my head, I think about them first. But I don't have time, so I'm just going to write it down. Key question. Together. Question 1. Question 2. Say it with me. Amongst the people that you hang around with, are you the smartest or the best investor in your circle of influence? Now, I happen to be one of these funny Christian types that reads the Bible, and there's a proverb in the Bible that says, as iron sharpens iron, so one man sharpens another. And it's my belief that sometimes we want to be acknowledged, so we're the smartest person that we know in certain areas. And that's fine. So that means that you're sharpening the people around you, which is an important thing to be doing, particularly if you're a parent, sharpening up your kids. But when it comes to investing, when it comes to these opinions, who's keeping you sharp? Well, obviously, I'm trying to do it tonight. That's why I'm running this event. But that's 2 hours in a week close to Christmas. How are you doing this in an ongoing way is a good question to ask. How can you get sharp? How can you stay sharp? Observation number 2, when people don't know what to do, they tend to do nothing. Now, there is a cost associated with doing nothing. It's called dollar cost decay. If you start with $1 and it goes down in value from $1 to 90 cents, there must be a speaker right here, it gets echoey. If you go from $1 to 90 cents, you lose 10 cents, but to go from 90 cents back to $1, you need to make 10 cents. So while you lose 10% on the way down, you've got to make 11% to get back to break even. 10 cents on 90 is 11%. If you had $1 and it goes to 75 cents, you've lost 25 cents or 25%. To go from 75 cents back to $1, you have to make a 33% return. The principle is it takes more effort to go back to break even than it does to go from a value down. It's easier to lose money than it is to make money. Third example, to go from $1 to 50 cents, you've lost 50%. To go from 50 to $1, you've got to make a 100% return. And then to go from $1 to 25 cents, yeah, you've lost 75 cents. But to go from 25 cents back to $1, you need to make a 300% return. So the cost of doing nothing in a market where asset prices are falling, whether it's shares or property, is the extra work that it needs to take to get back to break even. Has anyone ever seen a treadmill or been on a treadmill before? All right, so imagine that the treadmill is, instead of the treadmill going forwards, the treadmill's going backwards, right? So in order to stop going backwards, what do you need to do? You need to go at the same pace as the treadmill, right? Now, if you want to make progress, you've got to go faster than the treadmill. So in a market where prices are going down, you need to do the extra effort to go faster than the treadmill going backwards, just to break even. Now, for you guys that have been through the global financial crisis, may still be holding assets that have gone down in value, the realization I want to give you is that if your premise is to hold that asset till it regains its value, you'll need to make more as a percentage return to break even than you have lost to where you are at the moment. And the question you should be asking yourself is not, will it go back, but what return is necessary to get it back to the point that I'd be happy to sell at? And is that realistic given the nature of the investment that I'm holding? And if not, are you prepared to sacrifice your future financial performance for the sake of being right? Or are you better off asking yourself that first slide from tonight, which was, and if the opportunity isn't in this asset, are you going to sit and wait until the opportunity happens to be in that asset, or do you reposition yourself to take advantage of the opportunity? Good question to ask. There is also, in times like now, people tend to hold cash because cash is buying power, and that's actually a smart strategy. So if cash was getting a 6% return and property was getting a 6% return, which one would you rather have your money in? Cash, because property values are going down and there's less risk in cash, so you'd be better off in cash than you would in property. But if cash was 6% and property was 0%, again, you're better off in cash. Why? Because at least you're getting interest. And if property is actually going negative, then where's Mr. Pessimist? If property value is going down, as I said before, your cash buys more. So you're actually increasing the purchasing power of your cash relative to the value of real estate. But if real estate is 10% and cash is 6%, then your cash is now buying less property. So you're losing pace with what's happening to real estate. So holding cash makes sense in down markets like we're in at the moment. But purchasing power gains can quickly be eroded when the market turns. So yeah, right now, holding cash, if property prices are going down, 2 thumbs up, you're doing well. But when property prices bounce, by the time you do something about it, those gains you made by holding cash could quickly evaporate. So what's the principle? When the property market turns, and it will, many investors feel that they missed the boat because they didn't invest when they should have. And they say, I'll wait for the boat to come around next time. Well, if we went back to that graph of house prices and people said that in 2000, how would they be feeling now? Well, the boat may not come back to the year 2000 prices. There would have to be a massive crash in property values and our banks would fail. And given that the banks have guaranteed government bank deposits up to 250 grand, they'd be printing money faster than they could make it, and so we'd have inflation problems. So we don't want a property crash for the sake of buying cheap property because you probably wouldn't have any money in the bank left. There'd be hyperinflation and you couldn't borrow. Right, so there are 2 types of real estate profits. I'll talk about this in the DVDs that you're getting, so I won't labour on it tonight. There are 2 types of profit you can make from real estate. The first one is growth. No rocket science there. The second one is income. So that's the type of profit. And then we have 2 types of passivity. Your gains can either be generic or they can be manufactured. All right, so a generic profit is a profit that is market driven. It's not within your control and it's usually bought rather than made. So an example of a generic growth profit would be capital growth as a result of the market going up, the whole market going up. An example of generic income would be rental income that you just buy and the rent comes in. An example of manufactured growth would be your typical value add type deals, renovating, subdividing, developing, but even strategies for increasing the value of the property, which might be manufactured income, thinking about ways to increase the rent, also then getting into vendor finance or lease optioning or vendor carryback or these kind of sort of more strategies on the fringe. Where do you think most Australian property investors are on the combination of growth or income? And all the people said? Growth. Good. Most property investors in Australia are growth focused. And do you think most property investors are generic or manufactured in their passivity? Generic. Good. Well done. Not rocket science, but I'm glad you're with me. In the current market, do you think that a growth generic strategy would be an effective strategy? No. Why not? Because the market isn't delivering the return that you want. Now, when you invest, it's no fun. Let me just fix that. When you invest, it's no fun not being in control of the outcome, particularly when your financial future is on the line. So what we want to do as investors is we want to transition, ultimately, particularly if we want to be financially independent, away from growth into income. And in the short term, we probably want to go away from generic to manufactured to increase our investing kitty, and then eventually end back over in income generic. The point I wanted to make to you tonight, though, is the realisation that if anyone in the room here is a generic growth investor, that's a fantastic strategy when the market's going up. My research shows that the property market goes up about a third of the time, significantly, and 2/3 of the time it's flat or sideways. So a strategy that's only effective a third of the time isn't going to deliver the goals that you necessarily want, which is why so many investors only own 1 or 2 properties and have to continue to work because they don't get enough growth to replace their income consistently. So, observation number 3. In more difficult markets, generic profits and passive investors underperform. So markets like we're in at the moment, if you are a generic passive investor looking for a growth profit, you're probably going to underperform. So what do you need to do? You need to focus on your skill, because it's your skill that allows you to drive your profits in markets where those profits aren't being delivered. Have you become more passive in the current difficult market because you haven't known what to do, which is the natural tendency when you don't know what to do? What do people do? They put their investing on hold until things get better. Have you become more passive recently in the current market? Therefore, instead of moving on your treadmill, you've stood still because you haven't known what to do. And all of a sudden, you start going backwards. Because in the current market, things are going backwards. When in actual fact, what you should be doing is working harder than ever, transitioning from generic to manufactured to drive your gains. Why don't people do it? Because the bottom line is they don't know what to do. They lack the skill and the education to be able to do what they need to do. Observation number 4, risk is relative to investing skill. Do you know why you're not doing more with your investing? It's because you can't stomach the risk. Now, you might blame it on I can't get finance or whatever else is happening, but if your financial future was a must rather than a maybe, then you'd push through these reasons, these bits of cardboard that are stopping you from achieving your investing potential, right? You'd identify them and you'd take them away. You'd find a way to make it happen. If I held a gun to your head and said, I'm either going to kill you or you're going to find a way through, you'd find a way through. Or you'd die trying. But often our investing goals are just maybes rather than musts. So, observation number 4 is risk is relative to investing skill. If you can solve the risk, the fear that you face, then you'll be able to move forward. There are problems and there are profits. Now, in the second book I wrote, which is no longer available because one of the guys who was featured in the book ended up being a con man, and so the only way that I could protect people reading the book from potentially investing with this guy and losing their money was to pull the book. But anyway, one of the principles of that book was that the profit, that's the third one, the profit follows the problem. Problem plus solution equals profit was the mantra. So in real estate, there are solutions and there are, everyone says, there are solution properties and there are, remember how we did that example before, the 500 and the 400,000 property? Now, you need more skill and there's more risk buying problems. But there is more profit, skill-based profit, when you buy problem properties. At a couple of these market updates, when I do the Q&A time, people say, Steve, do you think I should buy a new off-the-plan property or do you think I should buy something a little bit older? And I say, look, if you buy an off-the-plan property, you are buying a Solution, the developer bought the problem and solved it. So the only way that solution properties make money is how? From a generic gain, either capital growth or income, mostly growth. So in the current market, buying solution properties is probably going to be ineffective. Now, coming back to this notion of, all right, now I'm starting to see that I need to buy more problems than I do solutions, even though there's less risk with solutions. Need to find inefficiencies and solve them. The reason why you won't do that is because the risk is higher. So let's talk about risk. There are 4, count them, 1, 2, 3, 4 quadrants of risk. This is a little bit sort of, self-help kind of stuff, so bear with me for a moment. There are the risks that you know. If you go and look at a property and you see that the floors are all wibbly-wobbly, you know that there's something wrong with the floors. So you can choose to do something about it, or you can simply take on the risk. So that's green, that's relatively low risk because you know it. There are also things when it comes to real estate that you don't know. Can anyone think of what one might be? Electrical problems with the wirings because you can't see the wiring behind the wall. What else? Termites, an even more prevailing one. You don't know if there's any white ant problems. So in the things you don't know, again, you are empowered to do something about it if you choose to. Otherwise, you take on the risk. This is very important. I'm feeling like you're starting to fidget and move. Hang in there with me. The third one is things you don't know that you know. You actually know these things, but you're not aware that you know about them or you've forgotten them. And these are things, it's now orange, which is caution, because these are the things you've probably learned in the past that aren't at front of mind, that if you forget about them could cause you pain again. But the greatest risk area, and ultimately the thing that's causing you the greatest amount of pain, are things you don't know. The things that are out there that you're afraid of, that you don't even know that you exist, that are preventing you from moving ahead. So Steve, tell me, help me, how do I get ahead? How do I bust through? How do I achieve my full investing potential? Tell me, what do I do? It's not rocket science. You reduce what you don't know, which is a process of education, because if we can shrink this down, then it won't be such a nightmare. And the second thing is, well, once you know it, apply it. Observation number 5, talking about the bulls is not the same as getting in the bull ring. If you're one of these people that likes to surf around realestate.com.au and check out what's for sale, if you're someone that would have made a lot of money if you had have got in the market 5 years ago but you never got around to doing it, or you're someone who's going to make a lot of money in the future but you're not prepared to do something now, then I've got a simple question for you. Are you ready for it? What's it going to take to get you to do something? I don't know. What's it going to take to get you to go that next step? How hard do I have to kick you up the backside to get you off this comfortable spot that you're sitting in or standing in right now? Because talking about bulls is not the same as getting in the bull ring. That's actually a Spanish proverb. Observation number 6, to cease to move forward is to backslide. We've talked about that with the treadmill. We're coming to the end of this session, and a really good point to leave you with is, what opportunities have you missed out on while you've been too busy not looking? What opportunities have you missed out on over the last 12, 18, 6 months, last week, while you've been too busy not looking?